Welcome to this video today, which is all about Forex trading price action for beginners. I want to look at the basics of a successful trading strategy just using price action. Now, in terms of Forex price action trading strategies, are they too simple to make money? Now, in terms of simplicity, I'm all for simplicity in Forex trading. Simple methods work the best. However, there is a real problem with Forex price action trading strategies you see online. Most of the people who promote them, they promote strategies that are simply not going to work. And it's easy to see the ones that won't work because, basically you never see any trades, do you? If you look at the people who teach price action trading strategies, they will say they did something after the event or just give some vague advice like, if it gets up to a level, buy it. If it breaks through, sell it. If it doesn't, well, that's easy, okay? You don't see the trades. Now, in terms of that's very important because I think a lot of people are obviously attracted to simple trading strategies that use price action because they're so time effective and, they're put up as very easy to learn. Now, in terms of price action trading, also it was much more effective, let's say 20 years ago, than it is now due to changes in the market. So I want to go through the problems with price action trading, how to become a good price action trader, and also changes in the market. So we're just going to discuss this in a little bit more detail. I'm just going to put points up on a storyboard and talk over them, and then you'll see why price action trading is not as simple and easy as most people make it sound. So let's just take a look and review why. All right, let's look at price action trading in a little bit more detail. Let's first of all start with the belief that it's based upon. All known fundamentals are immediately discounted in price action. So let's say a news event comes out, it's immediately in the price, so all you need to do is follow price action and nothing more. Now, this assumption is incorrect, and it's been proved by a number of traders, perhaps most famous being George Soros with his theory of reflexivity, and you can look up full videos on the theory on our channel. But just to give you an idea of what he was meaning in the theory of reflexivity, let's say a bullish news event comes out, traders buy a currency. Now, is the news totally reflected in the price? No, of course it isn't, because traders react to their biases. So let's say they're making money in the trade they just opened. They might decide to add to it. Other traders might see the news event slightly after, want to get in on the action. Traders have biases. They will react after the news event has come out to it. Okay, it's just a simple example, but you can find out more in the video that I've just mentioned on George Soros. Now, in terms of, I've got points 1 to 6. I put the impact of the internet on price action. It's very important. Before the internet, you could make money with price action trading strategies. It was much easier. Why? Because trends were smoother. Okay, so let me give you an example. Let's say, bullish news event comes out for a currency. Who's got the price first? The floor traders. They can come in and buy. Who gets it next? Banks, big institutions. They come in. They will buy after the floor traders. Then after the banks and brokers, you're going to get the high net worth individuals who could afford price screens, which were a bit of a luxury back in the 80s and 90s when I started trading. They were very expensive. So then that group of traders comes in, and then the last group to react is the retail traders who either got the news from their broker or from the newspaper. So the buying is staggered, okay? Means you get a smooth trend. Today, of course, that isn't the case. We all get the news at the same time. So you get it at the same time as big institutions. What does this mean? Everyone reacts to the news event at once. Let's say it's a bullish news story. You get a big amount of buying come in. Then everyone's bought. There's no one else to buy, let's say. And prices whipshaw back. And you see a lot more breakouts fail today than before the internet. Also, the internet has made the market's much more noisy. You've got Massive leverage available today. Okay, that's going to make the markets more noisy, and yeah, traders, because they can get information, will try and react to every news story that comes online. So you get a lot of noise. Okay, so the trends are not so smooth. Now, in terms of today, yeah, volatility isn't particularly high at the moment in the markets, but if you look at daily volatility of any Forex pair, it's going to be 100 pips or more, okay? So if you take the view, which is been proven that moves within a day are mostly random, then you're going to have to place your stop outside of this random volatility. That means a stop at probably 100, 150 pips. So you've got to make 250 to 300 pips on the other side to make decent profits. Okay, so you've got to use a relatively wide stop, and you've got to make a good number of pips to make money. Now, there are a lot of price action traders who say you can trade with 30 pip stops or 50 pip stops. They're selling price action scalping strategies, etc. They don't work. And yeah, if you want the proof they don't work, just look at the person recommending that method of trading. They will never ever give you their trades because it doesn't work. So you need a reasonable amount of pips to cover your losses. And the reason I said 250 to 300 pips if you're risking 100 to 150 is, of course, probably going to win 50% of your trades. That's a very respectable hit rate. So you need those big winners to cover your losers. And of course, you've got a very noisy market as well. Now, in terms of a lot of price action traders, they will say you can set big price targets. I've seen some set the target on the chart of like 500 or 1,000 pips. You can't do it. You never have been able to do it from just simply a price chart. Why? Because the chart is a direct reflection of the fundamentals behind the chart, or the sentiment behind the chart. If you don't know the big supply and demand fundamentals, or if there's a bullish or bearish sentiment extreme, you cannot do ambitious targets. So I would say the most you could do is a few hundred pips, okay? Now, point number 4, it looks easy with lots of lines. And price action traders will prove, it works going backwards. They use lots of lines and lots of different variations of what might happen in the future, what happened in the past. And the more lines of support and resistance you use, the more likely it is that, prices are either going to break some of them, or support is going to hold, or it's one of those things where you can prove anything with technical analysis going backwards, and certainly if you use a lot of support and resistance lines. Now, it looks easy with lots of lines, as I've said, but the illusion of Fibonacci retracements, that's my next one, point number 5. This just is another excuse to add more lines to a chart. And with Fibonacci, I've always been amused why it's used in Forex trading. Fibonacci, a brilliant mathematician, he developed the number sequence basically to prove exponential growth. It was just simple mathematical equation. Traders have taken this number sequence and say a number sequence basically gives you retracements that are going to hold in the market. Let's say popular ones 50 and 38%. So if prices come back to those levels, you can very often buy off them as a level of support, for example. They do work sometimes, but they don't work at other times. You can just take any numbers you want, just skew the numbers, make them 52 and 32, and you'll find those retracements will work sometimes as well, not at other times. So it's ever so easy to prove price action trading works backwards. But like I said earlier, you will not see many price action traders or educators ever giving their trades because they know it doesn't work. Like I said, did work before the age of the internet, but not today. Now, you can use price action, okay? Nothing wrong with it. Simple systems or strategies always work best, but you do need intuition, experience of reading the tape, because there's no one setup that works all the time or has a higher probability necessarily than any others. You've got to basically learn by experience, okay? And I do know price action traders who do make money, but most price action traders that I know today actually just do use some simple filters to help them filter the charts. They don't get caught out by a major news event, or they look at the big long-term fundamentals, to set price targets and so forth. They don't do anything complicated, but they add filters in so their price action trading, when they're using the charts, is effective. They increase the probability of getting profits. I just really want to talk about filters in a little bit more detail, and intuition being used in association with your technical analysis. But before I do so, what I want to do, just give you some quotes that come from a hedge fund manager who used to work with George Soros, and these quotes, I think, really sum up how you should approach the Forex markets. Now, let me just show you these quotes. They only take about 30 seconds, then we'll come back to discuss. I'll get back after that short summary there and some quotes from hedge fund manager Colin O'Shea, which make perfect sense to me in terms of a Forex price chart doesn't move on its own. It's a direct reflection of big fundamentals and also investor sentiment towards the fundamentals. There is no, repetitive price action pattern that's going to constantly repeat. There's no hidden order to the market. If you actually have just a basic understanding of the fundamentals and sentiment, your price action trading will become much more effective. For example, if you've got a potential breakout on your charts and you read the news wires and everyone is bullish about the breakout coming, it's probably not going to happen, is it? Because sentiment is too bullish already. So you can filter that setup by avoid going with the majority, or maybe even looking to fade it. Also, in terms of setting ambitious price targets, the big fundamentals drive the chart. Now, in terms of if you want to look for the big fundamentals, again, you don't have to do anything complicated, okay? Just look at the big supply and demand situation, by reading newswires. If you don't want to do that, what I would strongly recommend you do, and I'll put another video underneath this one where you can learn more about a certain indicator that will give you a shortcut to the fundamentals called the CFTC net traders positions, which basically show you non-commercial speculators against smart money commercials. Now, the smart money commercials basically know the big fundamentals, okay? So basically you can trade with them against the non-commercial speculators. You can watch the video underneath this one to give you more information, but it's one of the best ways to just learn what the big fundamentals are without actually researching them yourself. Now, in terms of if you were to look today at traders who make money, there are no pure price action traders really left in terms of the big funds that make money. Of course, in the old days, before the internet, you had numerous price action traders, like, for example, perhaps one of the most famous trend followers of all, Ed Secota. The trends were smoother in those days. The retracements, you didn't get such whipsaw moves. You could use pure price action trading, to get the odds on your side. That is not possible today. And as the internet dominates trading today, we've got bigger leverage, more people involved, the markets are much more noisy. So if you want to use a chart, obviously, to time your trade entries, etc., you can. I mean, the best way though is to use your charts, but know the fundamentals and sentiment behind the charts to filter out the best trades with the highest probability. And also, when you are doing your charts, if you just have a basic knowledge of the big fundamentals and the sentiment behind the chart, you'll focus only on the big support and resistance levels that matter. So you'll have very few lines on your chart, and you'll also focus on longer term moves and avoid very short term trading, which is essentially random. So that is the video for today. Hope you enjoyed it, and check out that video beneath this one from CFTC Net Traders. That will really help you make your technical trading more effective. Thanks for watching me as usual. Take care. Have a good day.